In this week's video, we'll take a detailed look back at video clips, charts, and concepts covered in 2017, allowing us to set the stage for another successful year in 2018. This video is a compilation of video clips from our weekly videos in 2017, allowing us to review the year in chronological order. Each clip will be dated via a caption like this. To find the complete list of 2017 videos in their entirety, you can Google Shavako Capital Channel. We'll jump right into the clips by joining a discussion from January of 2017 regarding PE ratios, illustrating that it's not particularly clear whether 20 to 26 is concerning and a time to run for the exits, or 20 to 26 is favorable and we might get a big run. Valuation, history shows, is an awful tool for market timing. Equity cycles persist, and selling just because price-earnings ratios are high has repeatedly proven a mistake. Sometimes it's very, very difficult to focus on the longer term when you're too close to the markets focusing on day-to-day volatility. These charts you can see haven't changed much. This is our MACD here. We still have the constructive look as of January 20th for the S&P 500 index. The same can be said for the Dow, and you can also see a long-term consolidation box. We also have a constructive look in place with black above red on the monthly MACD for the broad NYSE Composite Monthly. The more stocks that participate in the move, typically the healthier the market. This is the total stock market VTI ETF, black above red on the monthly MACD as of January 20th, 2017. The second item is something that Ed Sakota taught me. When a market makes a historic high, it is telling you something. No matter how many people tell you why the market shouldn't be that high or why nothing has changed, the mere fact that price is at a new high tells you something has changed. And from a pattern recognition perspective, the present day looks a lot more like the right side of the screen and really doesn't look anything like this low probability look here that we want to avoid. I find that major trends are now frequently preceded by a sharp price change in the opposite direction. Here's our sharp price change in the opposite direction prior to the U.S. election, and then we rally strongly, and the rally aligns with the long-term signal with the 30, 40, and 50-week moving averages. How does this help us today? It tells us from a long-term perspective, the bias is unequivocally up. And the reason for covering this now, at the end of February, we had the first monthly close. This is a monthly chart, so we need to see if it holds into month end. We had the first monthly close with RSI above 70. So you can make an argument that this period here is similar to this point here, and somewhat similar to this point here. So the next graph will show us the S&P 500 closed at 2173 in calendar year 2016 when we had this signal. What would it look like if the market from this point and this level followed a similar path, a similar path, and a similar path over the next 2.57 years? Here's the answer. This point here is similar to July 29th, 2016. We're starting at 2173, and then we're following the three paths from the three previous historical examples. If we went out 2.57 years, we would move from July of 2016, hypothetically, and this would be February of 2019. How does the same ratio with MACD on a monthly chart look today? The answer is still favorable. This look here looks very, very similar, or much more like the right side of the screen here, and really doesn't look anything like the lower probability look late in calendar year 2007. Therefore, we can learn something about the present day by looking at these exact same moving averages going backwards about 3 months as of March 24th, 2017. Rather than having this schizophrenic and indecisive and higher risk profile here, this is a high conviction look here. This is a full bore bullish look with blue, the fastest moving average on top. The answer brings us to our third major bullish factor that also helps us answer the question, how is it possible that good things could happen for a long period of time? From the book Market Wizards, markets operate more on psychology than on fundamentals. If we look at the exact same moving averages on April 20th, 2017, we can see for the most part that the present day chart looks a lot more like this bullish turn from the 2009 bottom and really doesn't look anything like this bearish turn here. And since April 28th was the last trading day of the month, we will be reviewing a handful of monthly charts, including the monthly chart for the NYSE Composite Index. This is our long-term consolidation. This is 1997. Price came down in this area 3 times. At the top of the box, price was in the same general area 4 times. Now we've cleared the box for the first time and held above it for the first time in 19 years. The NYSE Composite was able to rally in the second half of the month. It has a new monthly closing high, and it was up almost 0.4% in the month of April. On March 3rd of this year, we did that monthly RSI analysis, and we used these lines here to help us gain an understanding of what a normal pullback within the context of an ongoing uptrend might look like based on the historical cases. The purpose of creating that chart and going through that analysis was the following. When the market pulled back, it's easier to relax if you can look at a chart and say, based on history, this looks like a relatively normal pullback within the context of an ongoing uptrend. This is the exact same chart as of May 5th. Somewhat of a coincidence that the market stopped right at the first level, but we can see that the stock market gained 154% from point A to point B. Over this same 3,500 days looking backwards, the gains were extremely tepid, only 13% from point A to point B. This is a monthly chart here. This is calendar year 1997. This is 2017 as of May 25th. Some of you may have already recognized that price action between 2001 and late 2016 appears to be forming what's known as an inverse head and shoulders pattern. This can be a bullish pattern after you break out of the neckline. This is a downtrend here. This is a consolidation or indecisive period here. We get a shakeout, a bigger shakeout, the last shakeout before a bullish breakout. This is a monthly chart. It shows the performance of the NASDAQ Composite Index relative to basically TLT or long-term Treasury bonds. And everything that we have in front of us today aligns with moving into a green box like this based on the evidence we have in front of us right now. We have moved from a harder market into an easier market box. All 4 periods that look similar to the present day after a setup like this, good things happened for a long period of time. If we extend the chart out to June 14th, 2017, it's pretty easy to see that we did have somewhat of a toppy, concerning look that's similar to these turns here. But in this case, we switched over to that indecisive sideways type look. And our moving averages turned back up in a bullish manner, and we have a similar tight look here. This period here looks similar to this period here, and somewhat similar to this period here, telling us if our point A was here and our point B was here, and we tried to, for the most part, stay fully invested between point A and point B, we could have implemented that type of strategy for 32 years, which is quite a bit longer than 9.4 years. Anyone that entered this market here and exited here would have been absolutely, positively thrilled with their returns. It would have been very, very easy at this point here to say stocks cannot continue to rise given the state of the world. But stocks did continue to rise, and they did break out of a long-term consolidation box, and they did make a new all-time high here, an important new all-time high, just as we've done in 2016 and 2017. The CCM Market Model uses nothing but facts, hard evidence that we have in hand, and the conclusions are based on the weight of the evidence. Where the retest comes back and tests the bottom of the box, or the breakdown in this case, we have basically the same situation here, but it's a bullish breakout and a retest here and a successful retest. The math looks like the early stages of a long-term trend. What we have in front of us today still aligns with what we've talked about over the past year or so. The moral of the story for us is simply, as long as this bullish breakout holds, and that's to be determined, we take it day by day, this helps us remain open to much better than expected long-term outcomes. The same is true in the present day. A ratio like this is looking at every single conceivable thing that we can think of, and the market is looking at it on every conceivable time frame. Therefore, in the present day, do we have a concerning rollover look as we did here in calendar year 2007 when we look at the same ratio? The answer is no. On August 4th, 2017, risk on stocks versus defensive-oriented bonds, full-bore bullish look, all of this as volatility to ignore within the context of an ongoing uptrend. Why? The slope of the 200-day moving average never rolls over between point A and point B. So let's get more specific about August of 2017. We said this chart looked bullish in December of last year. How does it look today? These are the same, and for illustrative purposes, only 30, 40, and 50-week moving averages, and you can see we still have a full-bore bullish look. On the left side of these charts, it's prudent to keep our capital in harm's way. On the right side of these charts, it's prudent to start moving our capital out of harm's way. In the present day, the S&P 500 and our core positions, as evidenced by the look of these moving averages, are still in what appears to be a strong long-term uptrend, where any moves in this direction most likely would find their footing and be followed by a higher high. Back in December, we said the facts in hand look constructive. How does that same chart look today? Back here, we knew that the probabilities told us, the odds said good things could happen for a long period of time, and the moving averages as of August 25th, 2017 still align with that theory that good things could happen for a long period of time. It's prudent for us to ask, based on the facts that we have in hand, and if we strip out opinions, do the facts that we have in hand, are they leaning towards gloom and doom, or possibly a major boom? Remember, we're using simple examples to illustrate more complex concepts used by the model. How about our monthly MACD? We've covered numerous times in our weekly videos. This is the look that we want to avoid. This is a bearish rollover look. We want to avoid this. This is the look we want to embrace. How did the exact same chart and indicator, monthly MACD for the S&P 500, look the Friday before the collapse of Lehman Brothers? The answer is it looked absolutely positively ugly. And the bearish cross came well before. We could see this, measure it, and put it in a model before the calendar flipped over to 2008. The facts align with common sense. Intraday on Friday, Kathy updated the trend strength model, and once again, it is returning a score of 100. How extended is the present day trend, objectively, relative to the trend in early October 1987 and relative to the highly extended, we can see this, measure it, and put it in a model trend that was present in early October 1929. If we know September of 2017 really doesn't look anything like 1929 or 1987, how does the present day or the setup from 2016 compare to a period like 1994 and 1995? A counter-argument might be, but we haven't had a bear market in ages. We're overdue for a bear market. Clients and regular viewers will remember that we've already covered this topic, and we really don't agree with that statement. And more accurately, the facts don't agree with that statement. We've presented this stat before. This is USA Today, January 8th, 2016. The Standard & Poor's 1500 Index, a broad basket of large, mid, and small cap stocks, shows that the average stock's distance from its 52-week high is almost 27%. In terms of the broad market, we just had a bear market. Which brings us to our first Mythbuster. What does market history tell us about this common 2017 perception relative to the stock market? Stocks have been going up for 8 years. They can't keep going up. At face value, that seems logical. So if we take the exact same 8-year chart, put it in a smaller form, and box it up with a purple box, and move it to the chart that we were looking at previously, we can see that in this example here, this purple box is the same exact period shown via this purple box. Prior to this 19-year, 945% move in the NYSE Composite Index, the index had already gone up for over 8 years from this major low here to this point here. Clients and regular viewers know that the trend strength portion of our model that monitors the health of the market asks 207 binary questions using multiple time frames and multiple inputs about the market's short-term, intermediate term, and long-term health from a trend perspective. On Friday, October 13, 2017, no matter what question we ask or what time frame we look at or what inputs we use, 100% of the questions that we're asking about the market's health in October of 2017 are coming back favorable. Or said another way, what are the odds of a 1987-like stock market crash occurring over the next 5 trading sessions? Based on the facts, we can see it, measure it, and put it in a model on October 19th, 2017, we would have to say that the probability is relatively low. So while many are saying we should ignore the charts in the present day when we have bullish breakouts because ETFs and algorithms have changed everything, we could have made the exact same argument using numerous technological advances that had occurred in the rearview mirror looking back 25 to 30 years. Let's assume we had done that and said, this chart's meaningless. We would have missed a 515% gain that took place over 22 years. Does the present day look more like these bearish setups that we've just covered with the red arrows, or does it look more like these bullish setups that we've covered in these 2 examples where stocks after that rallied for a long period of time? If we fast forward to the present day, we see that ADX has a bullish look. This is our sleepy market here. It's turning back up, very similar to this turn here, similar to this turn here. And these discernibly different looks give us an excellent reference point for the present day. Does the present day look more like the right side of the screen or these red arrows, or does it look more like the left side of the screen and the green and favorable setups? If we fast forward to November 8th, 2017, the answer is easy. 455 calendar days ago, or back in August of 2016, we covered a relatively rare signal using weekly S&P 500 charts that told us to be open to bullish outcomes before and after the US election. If we fast forward to the present day, we can see the chart looks like exactly what we would expect based on the bullish videos that we've produced over the last 12 to 18 months, telling us if this bullish breakout holds, we should be open to much better than expected outcomes in the stock bond ratio relative to what we've seen over the past 18 years. Said another way, the next 18 years may look very little like the last 18 years. These type of headlines that were not particularly helpful in a year that the stock market has done well remind us the difference between information and utility. As we mentioned in past videos, most master chess players get really, really good by studying setups on a board. And even if markets exceed expectations for many, many years to come, we know with 100% certainty there is going to be normal, 100% to be expected, and gut-wrenching volatility at times between a point A and a point B that could be several years down the road. Like everything we cover in these videos, this helps us with nothing more than the probability of good things happening relative to the probability of bad things happening. From a long-term perspective, the probability of good things happening today is much, much better than it was at any time during this period here since the late 1990s, early 2000s. And the order of magnitude of the gains could be greater than 976%. Those are probabilistic statements that just tell us to be open to better than expected outcomes, not a forecast in any shape, form, or fashion. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM Market Model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.